the Fed and the rate hike expectations that are in the market today, and contrast that with this chart we have here from 2015 and the Fed talk in 2015 in terms of what the dot plot predicted versus what we're seeing today. This is a great graph from our research team. So thanks for putting this together. So walk us through what this graph really is illustrating here and what it could portend for the path forward.
Yeah, the idea here that we're trying to get across is ultimately at the beginning of a rate hike cycle, which you would say we're about to be on the cusp of another rate hike cycle. Nobody knows ultimately how much the Fed is going to be able to raise rates, not even the Fed. And so, we're in this time period now where we have things like the dot plot, we have forward guidance, we have economic projections, we have all this extra information that we didn't have in prior rate hike cycles, but we had it during the 2015 rate hike cycle. And that green line sitting there 3 months before the first rate hike. So this is September 2015. The first Fed rate hike of that cycle was in December of 2015. The green line is what the Fed said the path of rate hikes was going to look like. So by the time we got to late 2019, the federal funds rate would top out at about 3.25%. And the blue line is what they actually were able to do. So they ended up under hiking their own expectations by 1%. And then you can see what ultimately happened. Then we got into 2019, economic growth started to slow. The market started to call for Fed rate cuts, and the Fed had to oblige. They had to pacify the market, give in to the market's demands, and they started cutting. And then obviously COVID happened, and that's when you see the cut down to zero. So here we are in a very similar situation. We're about 3 months out from potentially the first rate hike, give or take a few months. And the Fed is saying that by late 2024, they're going to get the federal funds rate up to 2%. We'll see what happens, right? I mean, this is typically how it goes. When you put your projections together, it's, well, economic growth is going to be solid and inflation is going to it is running above target. That's why we're going to be hiking rates, and the labor market is going to heal, and there are going to be no recessions or hiccups, and I'm going to get the federal funds rate all the way back up to 2%. Look at how great we are. We'll see what actually happens, right? Talk is very cheap. Talk is very cheap.
So if we were to overlay this in a similar experience to 2015, we could see the federal funds rate capping out at somewhere near 1%. Is
Exactly
basically what this could potentially say. Small sample size of comparisons here, but very possible over the next 2 years for this to occur.
Yeah, and a very important theme in the outlook. They also could overhike too early. Mm-hmm. So if they set out on this cycle and they give you 4 or 5 hikes this year, well, then they're never going to get to 2% because then the market's going to start calling for them to cut. So the pace, the path, that is exactly what we're going to be watching this year. That'll determine if we're moving into the bear case or the bull case.
Yeah, as if you look back in 2015, there was that initial hike, and then there was a long period of digestion in that before the next hike there. So we'll see how they proceed through the year, which would be great because a lot of that will impact our outlook, the evolution of our outlook during the year.